All right, I just want to do a couple exercises here to make sure that we can understand the pricing of bonds. And so let's do exercise 14.1 first. And this is Madison Corporation is authorized to issue $800,000 of 5-year bonds dated June 30th, 2013. Stated interest rate's 11%, and interest is semi-annual, and the bonds are sold on June 30th, 2013. And so determine the proceeds that the company will receive when the bonds yield 12% and when the bonds yield 10%. And so, right, we know these are 11% bonds, so right, let's just do the first case where the effective rate is 12%. And in that case, we should get an amount less than $800,000. So let's just make sure. So it's 5-year bonds, and this is exercise 14-1. 5-year bonds, semi-annual. So N equals 10. And the interest rate, right? And so we're always using the effective interest rate here. And so in this case, the effective interest rate in the first case is 12%. But remember, it's semi-annual. So I'm going to divide that by 2, so I get 6. When I look at the payment, remember, because we're making these payments at later dates, the payment is going to be the amount of interest. And remember, the interest is 5.5% times $800,000, the stated rate, and that gives me $44,000. So remember, the payment is the stated rate times the face value. It's going to be negative, and so negative $44,000. And right, my future value, again, that's going to be negative because I have to pay that money back to the creditor is $800,000. And right, and I'm going to solve for the present value, and that's going to be a positive number. And so with my calculator, I'll end up getting 770, 559.65. And right, so I'll get debit cash, 770, 559.65. I'll debit. I'll debit discount on bonds payable. And that discount will be 29,000. Let me get my calculator here. 800,000 minus 775.59.65. 29,440.35. And remember, I'm going to credit bond payable for the face amount, $800,000. All right, the second case, right, they tell us that the effective rate on these bonds is 10%, so we should get an amount greater than 800,000. So N equals 10. My interest rate per period now is, right, the 10% divided by 2, or 5. The payment doesn't change because the stated rate and the face value are the same in both cases, negative 44,000. And the future value is going to be still negative 800. And when you hit your PV key, you'll get a positive amount of 830.886. And right, when we do that, we debit cash, 830.886. Bond payable will go on the books at 800. And then we have a premium on bonds payable. And that's going to be 30,886. And that will be our journal entry. All right. We've done the issuance. We are able to calculate that. Let's do one more problem here. Let's look at exercise 2 and make sure we can do these interest entries. And I'm sorry, let's do exercise 3 because in that case we have a different interest rate. And this is, I'm sorry, this is exercise 4. All right, so we want to do this. We want to be able to do a couple different things. So at exercise 4, they tell us that we have these bonds. It's $1 million, 9%, 5-year bonds, dated January 1st, 2013. The bonds pay interest annually on December 31st, and the bonds were issued to yield 10%. Bond issue costs associated with this transaction were $18,000. So we need to come up with the whole price of these bonds. So let's take care of the price first. So N equals 5, because they're 5-year bonds, but there's just annual interest. The interest rate per period is 10, right, because they were issued for an effective yield of 10%. And the payment is going to be negative 90,000, and the future value is going to be negative 1 million. And we should get a present value, right, when we do this. Of 962,092. 962,092, 13. All right. And I think if you do it with the tables, you get 962,091. But, we want to use the financial calculator. And so when we do this transaction, right, and I'm going to do it as 2 transactions. I'm going to take care of the bond interest costs separately. We'll have cash 962,092.13. In fact, we have a discount on bonds payable, and that discount's going to be 37,000. 37,907.87, and we'll have bonds payable $1 million. And then, in addition to that, we have to take care of the bond issue costs. And bond issue costs, right, we're going to debit an asset, bond issue cost, right, it's a deferred expense, 18,000, and we'll credit cash, 18,000. Anyway, we could have done this as one journal entry and debited cash up there for 944,092, but I'm going to just do it as 2 different entries. Now, when we do this, we have to amortize the discount, and we have to recognize interest expense. So remember, this was at January 1st. And now at December 31st, we have to take care of our interest, and we have to take care of our bond issue costs. So let's take care of the interest first. And so remember, we're going to pay cash, and that's the easiest part of this, right? We're going to pay cash of $90,000, and that's simply the payment. And we have interest expense, and that interest expense is going to be the carrying value of the 962,092.13 times the effective interest rate, and the effective interest rate was 10%. And so that's going to give us 209.21, and right, I'm going to amortize the discount on bonds payable, and that's going to be 6209.21. Now, in addition to that, I have to amortize those bond issue costs, and we do that amortization right to interest expense. We could have a bond issue expense, but normally they just do as an adjustment to interest expense. And that's going to be done on a straight line basis. So 18,000 divided by 5 years, we'll just do it on a straight line basis, and we get $3,600 per year. And we do that every period. All right. So there's exercise 4. And I guess we have to do, they ask us to do not just 2013, but also 2014. And I think, you know, those second interest payments, I'm not going to do the journal entry, but I'll just give you the amount of bond interest expense for the second year. The bond interest expense, December 31st, 2014. The interest expense is going to be $96,830.10. Let me see here, make sure I have. So 96,830.13 cents. All right, so we're set. We can do that. You know, one of the additional questions for exercise 4 is assume the company uses IFRS and that it issued bonds for net proceeds after deducting the bond issue cost of $944. Under IFRS, you wouldn't set up a separate bond issue cost asset, a deferred expense. What you would do is you would just adjust the effective interest rate based on the new amount of proceeds, and the proceeds would be net of any bond issue costs. And so now, instead of using a 10% effective interest rate, we would use the effective interest rate of 10.49% to calculate interest expense going forward and the amortization of any discount. All right, so there's exercise 1, which is pricing bonds, and exercise 4, which is pricing bonds, amortizing a discounted premium, and also the bond issue costs. And so we'll do some more of this, but make sure we have this down.